The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you.
Good morning, my name's John Addis. I'm the editor and founder of Intelligent Investor. And this morning I have with me here to eat some pizza is James Carlisle. How are you doing, James?
Great, thanks, John. How are you?
I'm very well, thank you. I do remember a story about Domino's Pizza from way back when a fund manager called Wayne Jones, who was part of the business in the early days, he was telling me about being in a store in Brisbane and the phone ringing for a takeaway order. And he saw Don May, the CEO and then CEO of Domino's Pizza, actually answer it and take this order. There aren't many CEOs who would work in the call center, but that's effectively what he was doing. Is it that makes this business a bit different from the other Domino's Pizza franchises around the globe?
Yeah, I absolutely think it is. I think it was almost instinctive, actually, is how I remember that story myself. It's like the phone went and he just grabbed it, because I think that is absolutely a point of difference. It's an incredibly well managed business, and you can really see why, because it has so many stores. 3,000 stores, and they all have managers, and the best managers go on to manage several stores and then several more stores, and then eventually the best managers get promoted into corporate roles and then regional executive roles. And Don May started off with a little pizza shop of his own up in Queensland, and then built that into several. And then he I forget the exact detail of the story, but he then got the Domino's franchise for Australia, and then sort of started building around that. And so it's the sort of survival of the fittest of management, and specifically of pizza shop management. And so they all, the best ones rise to the top. And when you listen to them on conference calls and things like that, and see them making the presentations, the detail they go into. I mean, look, I'm sure managements all around the world go into this level of detail, but it just, their love of it, their love of shaving minutes off delivery times. I think it's
obsessive.
It is obsessive. 1 minute of delivery time, I think they reckon, equals about 50 cents of cost on a pizza delivery. Wow. And so, you're dealing with a few dollars of gross margin. That's that's really significant. And they're absolutely laser focused on driving that down and on answering the call. A minute's delay, or then the phone hangs up and you've lost an order, and that person then won't order ever again, and he won't tell his friends to.
This does point to, I think, the key difference with Domino's and the sector it operates in. This is an incredibly competitive field, and yet Domino's has managed to build this global business with that kind of mentality. It is that makes this business really stand out in a highly competitive sector, isn't it?
Yeah, that's right. I mean, obviously restaurants are extremely competitive, but they have advantages as well, because pizza is probably the supreme delivery food. As long as you got that little plastic thing in the middle that keeps the lid off your pizza, it's very, very easy to deliver it in perfect condition.
That's right.
As long as you can get it there quickly. It's all about quickness. I mean, so 10 minutes doesn't just mean not keeping a customer waiting. It means that the customer gets a piping hot, crispy pizza instead of a soggy one. And so all these little differences makes all the difference. But they've got the perfect sort of canvas on which to work their management skills, if you like, because the little things make huge differences.
That's right. So can we talk about the global structure of this business and how it relates to the global HQ, which I believe is in the US? What is the structure of Domino's Pizza Enterprises in Australia?
Well, it's a master franchisee, or is it a sub-master? Look, there's the head company, Domino's, which then gives franchises out to sort of regions. and then within those regions, they give out franchises. So there's a franchise for Japan, there's a franchise for Taiwan, there's the franchises in Europe, France, Germany. I mean, these are the regions for Domino's, Benelux, Denmark. So that covers the geographic spread, and each of those countries or regions has a master franchise. And so Domino's are paying royalties up to Domino's US for the right to use the Domino's brand, and a bit of support around various things. I think there's probably a global marketing budget. I couldn't tell you about that. But that's the support it gets from head office, and it pays for that through a royalty on sales. And then within, say, Australia, each store operates as a franchise. You might have several stores in a franchise, and these sub-franchisees sign up a sub-franchise document with the master franchisee in or whatever they're called in Australia, and they then pay, I think it's 7% of sales to Domino's Australia, who then pay a percent or two of that to up the chain to the US.
Yeah.
And they also contribute, I think it's 6% to a marketing fund, a sort of joint marketing fund, which is just an easier way of Domino's to give comfort to the franchisees that the money they're contributing there is actually going on growing their sales.
That's, I think, from a marketing perspective, and I think Domino's just does an excellent job with their leafleting and TV ads. It's important to understand that when you're investing, say, in a television commercial campaign, the more stores you've got, the more you can amortize that expense over your network. So density is quite an important thing in this business from a marketing point of view, isn't it, James?
Yeah, absolutely. It's a question of scale, isn't it? Because the one TV ad covers a whole city or a whole region or whatever it is, and you only have to make it once. If you only had one pizza store, it wouldn't be worthwhile even to do it. But if you've got hundreds or thousands, then it you get the huge benefit from it.
Mm. And we upgraded this stock in August 2019. It was James Greenhouse who spotted the opportunity there at about $37. And in that review, and I think for members interested in this company, it's worth going back and having a look at it, when he talks about how, you see these very, very small stores. And we spoke about Levisa with Gaurav a few days ago. It's kind of like that. You have this very, very small store, but the throughput is huge. An average store in the high street sells about $1.4 million worth of pizza and garlic bread a year. And if it's doing well, it makes about $130,000 a year. So this is something where you really need scale to make this business work, because the margins aren't great. So those small differences that the small differences you make in your operations can really have a big impact on profitability.
Yeah, that's right. And the scale helps in a bunch of other ways as well. And this is really what they describe as their fortressing strategy. So the fortressing is a strategy whereby they basically try to fill in the gaps between gaps in their store network where they can't deliver as quickly as they would like to. So they'll fill in that gap, which cannibalizes sales in the first instance from the nearby stores, but really it was in an area which was being perhaps poorly covered by those other stores. So, the profits were marginal because the run times for delivery were too high, and people weren't getting great pizza, so their experience wasn't good. So you put a new store in there. Mm-hmm. And it creates its own demand because people see the brand, they see it on the high street, you see it walking past, you're much more likely to order a pizza if there's a Domino's at the end of your street than if you haven't, if you never see it. Yeah. And the delivery costs are much lower, and the product and the service is much better, much quicker, and so it creates its own demand. And again, it's all about that scale and increasing the store density, and gives you more revenue to play off those. And there's an element of fixed costs, you see, which is the marketing we were talking about before, but also Each store has a fixed cost in setting it up and all that.
So when you look at Australia and New Zealand, I think there's 8,900 stores now, which is quite a lot, but they still expect to expand that to about 1,200 for the reasons that you state by splitting territories. But the real growth in this operation is international. So let's just talk about where Don May has expanded into and what new geographies they've got under their umbrella.
Well, probably the biggest opportunity is in Europe. Well, look at Europe and Japan, but Japan's a little bit different. We'll come on to that perhaps. But just as an example, the population of the country per store, of the region served per store, is about 35,000 in Australia and New Zealand, and by comparison, it's about 55,000 in the US.
Yeah.
So and that's it's a little bit thinner there, I think, probably because the population's a bit more broadly spread. In Europe, it's more like 150,000 people per store. So you could see, to get down to the American level, you could have 3 times as many stores, and to get to the Australian level, you'd have 4 or 5 times as many stores. And they believe there's still room to add more stores in Australia and New Zealand. So that's a huge opportunity there in Europe. Japan is similar. The problem with Japan, I suppose, is there are some cultural barriers really to the pizza product in Japan, which probably don't exist in Europe. Europeans are sort of quite fussy about their food, but they're well versed in pizza, aren't they?
Yeah.
Whereas Japan, it's seen as being a bit of a novelty type of item, and they use it particularly for big occasions. So it's children's birthday parties, and it's big gatherings to celebrate public holidays, sort of Christmas, Golden Week holiday is another one. So big gatherings, but they're relatively sparse. And of course, they're happening hugely concentrated blocks. So you have a mad rush for a week, and then you go quiet for 6. And that makes it quite difficult to run the business. So in Japan, what they're really trying to do is change cultural attitudes and teach people that pizza can be an option for when you get home from work and you're tired and you don't want to cook. And so it's going to be a bit more of a challenge. They won those customers, incidentally, during COVID, which was, and this is roughly what the article that's just published is talking about, because they've been raking over the coals of what went wrong in Japan towards the end of last year. They won a lot of those individual single meal sort of customers last year, during COVID, for obvious reasons, because people were staying at home, but they just fell off a cliff in the aftermath when the restrictions were lifted last October. I think people celebrated by going out to restaurants, and the pizza was not on the menu for a little bit. And so, these are problems they're having to overcome in Japan. They've put a few healthier items. You'll see salads and soups on the menu in Japan, which you won't have here, and which don't travel so well. So that plays against their strengths in a way. But they're just trying to get people to understand that it can make a sort of a balanced meal. They're too healthy, the Japanese. Maybe that's the problem.
It's a very. I suspect it's going to be a difficult market for them long term, because even if you just go into the local store on the corner, the convenience store, the quality of the sashimi and sushi just in the supermarket is quite amazing.
Yeah, so and that's a product which travels pretty well as well.
And that travels really well. So I can see why it's difficult, but they're still kind of making a go of it, though. They seem to be doing pretty well. The store network's expanding. But really go on, sorry.
Sorry, I was just going to say, well, it's an opportunity as well, isn't it? You see, so the fact that they're so focused on this, or not focused, but the customer, I suppose, is so focused on these sort of occasions. It does give them that big opportunity of just, even if they can get a little bit towards the sort of maybe the family meal market instead of the individual meal. So there's a big opportunity there to grow if they can tap into a little bit of that. And if anyone's going to do it, I'd back Domino's too. So
Let's talk now about Europe. One of the misconceptions I think about France is that it's a very food driven culture, but they really love their takeaway food. I think the penetration of McDonald's in France is higher than almost anywhere else in Europe, and it seems as though Domino's has a plan to become another kind of McDonald's in France and Germany. How's that going?
It's going pretty well. I mean, it's Germany particularly. France was a bit more disrupted by COVID in the last couple of years. But I think, I mean, you mentioned McDonald's there, but really that's a takeout market, isn't it? It just doesn't deliver so well. And again, so that's really where the pizza shines in delivery. And that's where it's seeing all the growth. And I think I would expect that to grow pretty well in France, Germany, Benelux. These are countries very familiar with pizza, very, very busy and very, very familiar with ordering food and delivery.
Yeah. So they have a target, I think, approaching 3,000 stores for the European network by 2028.
Yeah, I'll take it. The targets are mostly expressed as by 2025 to 2033, I think. But I'll take your word for it. I can't remember the exact number, but they're certainly expecting to grow significantly. I mean, the global footprint is expected. They just repeated the other day at 9 to 12% a year for the next 3 to 5 years, anyway. And the global footprint, I should say, they're planning to double, but that will be sometime between 2025 to 2033. I think we can presume that it'll be at the later end of that. Although, of course, they're always looking at acquisitions, so it would not be a surprise at all to see. I mean, they acquired Taiwan in August last year, and it would not be a surprise to see them buying up franchises in some other regions.
Elsewhere, yeah. Okay. Let's now get to valuation, James, because Domino's is back on the buy list. When we recommended it back in 2019, I think it was about $37 a share. It went kind of crazy after then, has come back significantly since. Just give us the reasons, give us the arguments for why this stock is back on the buy list now.
Well, because it got cheap enough, essentially. Last year, it got up to maybe $160 at one point. It was really quite extraordinary because of this excitement. It looked for a time as though they'd cracked this single meal sort of market in Japan. Japanese sales were going through the roof. It turns out that was mostly a mirage due to COVID restrictions. But they have ended up with a slightly better position in Japan. They have ended up with higher sales there, more customers than they had before the pandemic. So, the position is improved, but it's not nearly as good as it was, as people had thought it was going to be in the middle of last year. So that's really why the price has come back. And so it gets to a point where it's attractive to buy. Earnings are likely to fall this year, really mainly because of that hiccup in Japan and some pressure on sales in some of the European markets, France particularly. So the PE for the price earnings ratio for this year's earnings probably a little bit over 30 still, but we think that's coming firmly down into the 20s over the next couple of years, and over time it's a business that we expect to grow at least in the double digits.
And the share price really has come back a long way since those highs of the pandemic highs of around 160. It's now less. It's
come back a long way since we upgraded it.
That's right.
I mean, look, this is the trouble being a value investor, isn't it? You see the value, but the market quite happy to keep selling something after that. So look, it's got a good bit cheaper since then. We upgraded about $85. And it's now about just a bit below 65. So looks like a good opportunity. It is going through a tricky spot. Well, it has been going through a tricky spot in Japan. The future in Japan particularly is under a bit of a cloud, I suppose. But there's a great opportunity in Europe. And going back to how we started, if this the management depth within Domino's is so good, if anyone can pull this off, I would back them.
That's the argument, and it looks as though the history with this stock that we've had over the past few years, there are opportunities to buy on bad news, and Japan and the problems they had there that have since come to light is one of those occasions. It's great to be able to talk about one of these stocks and our best 10 growth businesses that is on the buy list right now. So thanks very much, James. That was an excellent overview of the company, and we hope members enjoyed it. Thank you.
Pleasure.